All right, friends, mortgages may get more expensive. The Fed's monetary policy tightening may wreck mortgage interest rates more than we have seen in almost 20 years. Meaning the current 7% interest rate for the 30-year fixed rate mortgage may be the new norm for those wanting to buy a home. And guess what that means? Despite low housing inventory, the housing market may just see the price correction that many have been waiting for. All right, welcome back. And in this video, I'm going to provide you with some real data to show you what's going on in the housing market today, including why 7 to 8% mortgage rates may be the new great rate if you're buying a home. With 7% mortgage rates, get ready for the housing correction that I have been talking about for quite some time, since April of 2022. Now, before you poo-poo the idea of a housing market crash because of the lack of inventory, if rates don't drop back down as many are hoping for, many sellers may decide to panic sell their second homes or their short-term rentals despite their cheap mortgage rate, as they may fear of missing the boat on profiting should home prices decide to take a deep dive. Now, if we start to see people selling, this alone may increase the housing inventory that everyone has been waiting for. Okay, guys, before I say any more, if this is your first time watching, I'm Todd Sachs, a real estate broker here in Maryland, and this channel is dedicated to keeping you informed on everything real estate. And if you like it here, please consider subscribing to our channel so you can remain a very, very informed individual. And as always, please don't keep this content all to yourselves. If you believe your family and friends should see this video, please share it. The share button is below. And after watching this video, comment your thoughts and tell me what you're seeing in your town. I believe there is wisdom in crowds and everyone loves to read your comments. Since the financial meltdown of 2008, the Fed and U.S. banks have been major purchasers of what's called mortgage-backed securities, or what you may be hearing as MBS. No, MBS does not stand for mostly bullshit. All right, so let me take a quick minute and explain mortgage-backed securities. And no, I'm not a financial advisor. Okay, so you go to the bank to get a mortgage, and the bank gives you a mortgage for, let's say, $500,000 at 8% for a 30-year term. Now, before we had mortgage-backed securities, the bank would keep your mortgage loan on their books and collect the principal and interest payments from you for 30 years. Then one day, the banks came up with this brilliant idea of bundling up these mortgages in a pool as a bond known as a mortgage-backed security. And then they started selling these mortgage-backed security bonds to investors. So we now know this as the secondary mortgage market. So the pools of mortgage loans are classified into certain risk categories and sold to investors. Now, you may be asking, well, if the bank sells your loan, how do they make any money? Well, they do so by charging you what's called loan origination fees to underwrite and provide you with the actual mortgage. And once they sell your loan to the investors, they still collect your monthly mortgage payment. And in most cases, the bank maintains your escrow account so that they can pay your property insurance and property taxes. And by making sure that your property taxes and insurance are paid on time, this helps to protect the investors. So to collect your money and pay some bills, they charge the investors what is known as a loan servicing fee. Plus, don't worry, the banks collect other fees as well. So now let's talk about when and why the Fed actually began buying mortgage-backed securities. Well, guys, the Fed started buying mortgage-backed securities in 2009 during the Great Recession. And this was done to increase the economy's cash flow and to prevent the housing market from failing. In other words, if there isn't enough investors to invest in home mortgages, mortgage rates would have skyrocketed if the Fed didn't step in. So to keep the mortgage rates low, the Fed decided to jump in and buy the mortgage-backed securities, this allowing for more people to afford buying a home, as most of the U.S. population actually needs to finance most of their home purchase. Now, the Fed uses the tool of raising and lowering interest rates to either slow down or stimulate the economy based on the current economic conditions. And unfortunately, they kept them too low for too long. And by creating this cheap lending, it has allowed home prices as well as everything else to just skyrocket. Now, y'all, let's not forget to mention that when prices rise, like home prices, for instance, the government does make more money on things like higher property taxes and just taxes in general. And geez, let me not forget to mention our friends, the insurance industry. Oh, and utility company Allies. They get to profit from higher consumer costs as well. All right, let's get back on track. With the Fed buying so many mortgage loans, they've created their own balance sheet mess. Let's just have a look at this chart. What you're looking at here is the amount of mortgage-backed securities held by the Federal Reserve. Now, I tried to figure this out on my own, but guys, my calculator doesn't add 13 digits on the screen. But currently, it's over $2.5 trillion. And you can see on this chart that where from the pandemic until recently, the Fed was a major buyer of these mortgage-backed securities. And now as the trend line indicates, you can see that they're trying to reduce that liability that they have created. Okay, now, here's a great time to mention that originally the Fed back in November of 2008 announced a $600 billion program to help purchase mortgage-backed securities to lower mortgage interest rates. And it grew to almost $2.8 trillion in March of 2022. Guess when the Fed started raising interest rates? You guessed it, in March of 2022. Now, what will happen if the Fed continues to reduce their mortgage-backed securities? This would mean that they would need to stop buying or significantly reduce the buying of mortgage-backed securities. In fact, reducing mortgage-backed securities is in their plan, and on that chart, you see that they have already started to do so. So this may mean goodbye forever to the low mortgage interest rates. You see, ever since the Fed started buying mortgage-backed securities, the 30-year mortgage rate has been in the 4% plus or minus average range. And on January 7th of 2021, the 30-year mortgage rate fell to the lowest ever, to an all-time low of 2.65%. This, my friends, is probably one of the single most reasons people started to invest in real estate and snatching up all the homes on the market as fast as they could. Hence, bidding wars, investors competing with wannabe home buyers, and the skyrocketing home prices. Is this starting to make sense? So let's have a look at this chart of median home sold prices through the years. In April of 2020, the median sold home price in the U.S. was about $322,600. And through about the same time, just 2 years later, in 2022, home prices skyrocketed an average of 39.3%. Guys, that's almost 20% year over year to an all-time high of $449,300. That is the amount on average for anyone to achieve the so-called American dream of homeownership. But look closely. Overall, despite what you're seeing in your own town right now, for the first time in almost 20 years, median sold prices are dropping like a rock. This is a result of the Fed raising interest rates, as you can see on this chart right here. We all know that home prices are very interest rate sensitive, and that's because since World War II, it's all about the cost of the monthly payment when buying a home. So not actually the home price itself. Unfortunately, this time, the buy the payment mentality may actually catch us once again, just as it did in 2006, right before the housing market crash of 2008. So the issue with this is that should home prices decline below what you paid for your home, and should you need to sell for any reason at all, you may be underwater on your loan. Guys, you may be saying, what in the world would cause home prices to continue to drop? Well, they may drop if the mortgage rates return to the historical average of around 7.5% and stay there for some period of time. Without the 4% mortgage, sorry sellers, you may not get the same profits you've gained during the last 3 years. That is, unless people start making a lot more money. And the Fed said that there has been recent softening of wages, so I don't think this is an option. Now, to stay with this narrative, let's check out this recent Forbes.com article. According to Forbes.com, this article implies that the Fed may not raise interest rates in June and that mortgage rates are predicted to decline the remainder of 2023 and 2024. For the election, I would imagine. Let me also point out that this same article says that the current state of mortgage rates indicate the average mortgage rate for a 30-year fixed rate mortgage is 7.2%, nearly double its 3.22% level in early 2022. And that the average cost of a 15-year fixed rate mortgage has also surged to 6.5% compared to the 2.43% in January of 22. And it also goes on to say here that in the current environment, ARMs, adjustable rate mortgages, might be more affordable than those with fixed rates. The latest average for a 5/1 ARM was 5.92%. Yikes. Guys, seriously, we're going to actually push people now to go back into these adjustable rate mortgages. Man, I see disaster on the horizon if that's the case. And one of the reasons, guys, that I am not a big advocate of the ARM is because I don't really believe that mortgage interest rates are going to go down and stay down. I think they're going to go back up. And this is why. So if the Fed is investing less in mortgage-backed securities, which has actually helped mortgage rates to stay historically low, who will be buying these mortgage-backed securities? Many financial experts believe it will be back to the money managers to bring investors back as the primary buyers of the mortgage-backed security. And you have to ask yourself, if money managers' purpose are to bring high returns for investors, in order to entice these investors to invest in long-term bonds like mortgage-backed securities, do you believe mortgage rates might return to their historical average of about 7.5%? Or do you believe the Forbes article that low mortgage rates will return and for how long? Please drop your comments below. And thanks so much, guys, for hanging out with me on this video. And if you liked it, you can let me know that you did by hitting that thumbs up. And if you haven't already subscribed to our channel, it'd be great if you did so now. Smash that alert bell. You'll know every time we upload content just like this. See you next time. Sachs Realty, Maryland broker number 607720, office number 443-318-4514, equal housing opportunity.